Hello, my name is Anna Khazen, and I'm responsible for BlackRock's Financial Institutions Group in EMEA. I'm delighted to be joined today by Mark Azzopardi, BlackRock's Global Head of Insurance Solutions. Today, Mark and I join you for a deep dive into BlackRock's 11th Annual Global Insurance Report. This year, our survey, which was conducted in June and July, covers the views of 370 senior insurance executives across 26 markets. Together, they represent more than $28 trillion in investable assets, approximately 2/3 of the sector. Amongst some of the key findings of the report is that over 3/4 of the survey participants plan to review their strategic asset allocation. Mark, given how meaningfully the macroeconomic and market backdrops have changed this year, 79% of survey respondents expect to review their strategic asset allocations. Can you set out the backdrop for this new environment?
Yes, sure. Thank you, Anna. Yes, so 2022 has been a pretty interesting year. So we've seen a significant market volatility. Spreads have widened, rates have risen, equities have fallen. And all this has happened during a period where there's been a significant surge of inflation and kind of testing liquidity in markets. And there's been a geopolitical environment which has been somewhat challenging as well. So in this context, it's perhaps not surprising that relative and absolute asset class preferences that maybe pertained a couple of years ago should change. And in fact, they have changed. So this is part of the backdrop. But even that's before you start considering the way in which the current environment is impacting liabilities, because of course there's market risk embedded in liabilities as well. And particularly for P&C insurers, the way inflation impacts their liabilities will have an impact on their asset allocation, because clearly liabilities are an important part of ALM, and ALM is a significant constraint on asset allocation in general. So insurers are thinking very hard in the current environment about what they should be doing. There are a number of key questions, I guess, which come to mind. So the first one is, what is the risk budget that I should actually be allocating to investments in this framework? And for property casualty insurers in particular, how should I allocate my total risk budget between investments and underwriting? Because we're currently in many P&C markets in a hard market. So the allocation of capital between investment risk and underwriting risk is an important decision for them to make too. Another question that they're asking, especially with illiquidity front and center, is the role of private markets in the portfolio, and whether the role of private markets changes given the higher interest rates and the liquidity constraints that we have. And also questions around which assets to hold, frankly, in the current environment in order to have a portfolio which responds more directly to various types of inflations to which insurers themselves are exposed.
Thanks very much, Mark. And against that backdrop, what is the framework within which BlackRock thinks about strategic asset allocation for insurers?
Yes, thank you. So at BlackRock, I guess the primary input to our asset allocation work comes from the BlackRock Investment Institute, which every quarter publishes a series of capital market assumptions, or CMAs, which are basically a set of risk and return forecasts for a variety of asset classes in multiple currencies. And these are global asset classes as well. So we get these forecasts for risk and return. We also, through the BlackRock Investment Institute, maintain forecasts for yields, for credit spreads, and also for credit default and transition probabilities. And we use these in particular for constructing income-focused portfolios, which clearly are of significant relevance to insurers. So those are the primary inputs. The BlackRock Investment Institute also maintains a database of alpha that you can generate in each asset class with various levels of conviction. So there are effectively percentile readings for the alpha you can generate in each asset class. So depending on your conviction in active management, you as the client can select the level of alpha, if any, that you'd like incorporated into the exercise. So these are the starting points. Obviously, general account asset allocation is quite meaningfully constrained by ALM. And so one of the first things we do is to engage clients on their views around the various objectives and constraints that should go into the exercise. So primary amongst these will be the risk budget they're going to allocate, their attitude to duration and FX mismatches in the strategic asset allocation. Also, we create a liquidity framework, or at least agree on a liquidity framework with the insurer, so that we can then set a liquidity risk budget to kind of inform the asset allocation that kind of an insurer will be happy with in the end. And then finally, we've obviously got the particularly insurance pieces to it, which are the regulatory capital charges, the accounting constraints, and some of the rating agency constraints under which insurers operate. So armed with all of that, and it's a lot of information, we kind of create a set of initial portfolios that look plausibly as though they will satisfy the insurer's main objective and constraints. And we do this by using a set of optimizers and stochastic projection tools that we have here in-house. Once we've done that, we road test a few of the portfolios by firstly creating or calculating some metrics relevant to the enterprise. So these might include the solvency capital evolution through time. They might encapsulate also the ability to distribute dividends through time. But we'll also stress test all of those using our Aladdin risk models and stress testing capability to make sure that a portfolio which ostensibly is economically efficient and complies with the various constraints that the insurer wants us to comply with, but it nevertheless passes the sniff test, if you like. And when put through a series of either historical events, stress events, or putative future events, behaves in a way which the insurer finds acceptable. So I think broadly speaking, that's the process we go through. It's a highly iterative process, and I guess no two processes are ever actually the same, or no two client engagements are actually ever the same. But fundamentally, a lot of what I described is reasonably common to most of the insurers we work with.
And so on that note, how would you expect these revised SAAs to differ for different insurance companies?
So you're right, there can be some quite meaningful differences actually, because even though the process that we go through is essentially the same, a lot of the environments in which insurers operate are very different, and that's particularly driven by the liabilities. So, for example, property and casualty insurers have a variety of quite volatile liabilities actually, which are very sensitive to inflation. The sheer volatility that they experience with those liabilities may lead them to be quite constrained in the way they take risk with their investments. And the current inflationary environment is quite challenging for them because, as I said, most of their liabilities have got inflation embedded in them, but unfortunately, it's not the nice, easy, measurable CPI type of inflation that you can buy assets to help hedge or protect you against quite easily. Actually, it's inflation which is effectively embedded in the underlying claim. So, for example, if you're a motor insurer and you have a motor liability claim, then the inflation to which you're exposed is the inflation or the wage inflation that you need to pay to a worker who's caring for someone who might have been injured in a car accident, for example. And it's not always easy to find assets that respond well to those types of inflation risk. So that's one challenge they face, which will have an impact on the asset allocation. Another challenge they face is that property and casualty insurers write a number of excessive loss contracts, which effectively have embedded gearing in them. So even when the insurer has got its head around the type of inflation that it's exposed to, it can actually sometimes be quite difficult to understand how much inflation you're exposed to, because the amount of inflation you're exposed to is a function of how high inflation is at any one time. So it's changing through time. And that makes it actually quite difficult to find assets that will behave in a similar way. So one of the ways insurers deal with this, or try to deal with it, is by basically putting prices up. If you put prices up, you can build in a buffer against inflation. And this is in theory easy to do because property and casualty contracts renew annually. But in practice, you don't know whether the market will bear the price increase you want to impose. That's the first issue. And I guess the second issue is that even if the market will bear the price you want to the price increase you want to impose, unless you actually invest the premiums that you take in a way or in assets which respond to inflation in the same way as your liabilities do, you don't actually know a priori whether that price increase is enough. So that's, again, quite a challenge for P&C insurers, which will, all other things being equal, cause them to be wary about taking too much risk. Life insurers, on the other hand, have got slightly different dynamic. I'm not saying it's easier, but it's definitely different. So predominantly, they look to invest premiums against relatively stable liabilities and earn a spread. So that's the fundamental business model. But depending whether you're perhaps running off a book of business, maybe you're a consolidator running off some legacy books, or whether you're active in the market, you might end up with quite different asset allocations. Because if you're running off a legacy book, you might take the view reasonably that with yields where they are now and potential returns where they are now in public assets, you might go for a capital light approach effectively and buy a whole series of quite secure bonds, very carefully liability match your portfolio, and run off the portfolio with very little investment risk, and run a tight and efficient ship, so to speak. On the other hand, if you're currently in the market marketing investments or savings products, then you need to compete with other players in the market. And one of the main ways you compete is by obviously declaring crediting rates and bonuses which are at a par with or higher than your primary competitors. So it's actually important to think quite hard in that environment about which assets to invest in and how best to maximize return without taking undue risk. So again, big differences in outcome. You operate the same process, but you get quite different outcomes depending whether you're a P&C insurer or a life insurer, and even if between whether you're active or in runoff, so to speak.
Thank you very much, Mark. And so finally, to wrap it all up, what topic are you following most keenly on the back of these revised SAAs? Well,
so the topic that I'm kind of most focused on is that I'm quite curious to see how the whole attitude amongst insurers to private markets pans out. So I think, as we all know, over the last few years, insurers, particularly life insurers, have invested quite meaningfully in private markets and in the whole governance framework to support investment in private markets. And there is a thought among some people that with private market assets now, with public market assets now able to generate quite high returns, that insurers' interest in private markets may wane somewhat. It's possible. I mean, against that, though, there are some quite compelling reasons to stay with the asset class, I think, or with private markets generally. So the first one is that private markets provide, in many cases, different sets of exposures. You get exposed to different risk factors that are sometimes hard to find in public markets, and having diversified exposures is kind of one of the ways to ride through volatility. So I think that's quite a powerful argument for staying invested. The second one is that by definition, private markets are actively underwritten, and so you can actually your companies do spend a lot of time getting the terms and conditions right, and that should provide them with more comfort that the assets will perform well in a volatile and difficult market than perhaps if you were participating in a kind of publicly issued bond where you wouldn't have any control over, really, or as much control over the underwriting of those assets. And related to that, also, if you're investing in private markets, you can clearly tailor the characteristics of the private market to your own ALM constraints, which insurers, particularly, for example, in the UK with matching adjustment kind of type liabilities, insurers find very, very advantageous. So that's another good reason, I guess, to stick with private markets. On top of that, obviously, as long as you manage a liquidity risk, insurers start from the very fortunate position of having some pretty illiquid liabilities, especially on the life side, not so much on the property and casualty side, but on the life side. And so as long as you understand that illiquidity of the liabilities well, then harvesting an illiquidity premium through the assets is effectively an economic and regulatory free lunch. You harvest that premium without having to pay an economic cost or a regulatory capital cost. So It's another kind of reason. And I think finally, I think it's worth saying that building the infrastructure to originate and maintain and govern private asset allocations is non-trivial. So having built it, it would be a shame to let it stagnate. So I think there's a lot to be said for insurers keeping an involvement in the market so that they can be nimble and kind of increase allocations as and when the market environment changes. So I think there's a whole series of reasons why you might want to stay invested compared to the initial thought that maybe public markets will get you where you want to without all the trouble, so to speak. But the Global Insurance Report, I think, indicates that on average, insurers are looking to allocate an extra 3% to private markets over the next few years, and in some cases, a lot more than that. So it seems that I'm preaching to the converted to some extent, and insurers already know that staying invested in private markets is a good idea. They'll be diligent, they'll be cautious, but I think they'll play invested. But I'm curious to see if reality pans out as I think it will.
Well, I'm sure we'll have many follow-ups with our insurance clients on that topic. Mark, thank you very much for your valuable insights. Please do reach out to Mark, myself, or our other BlackRock colleagues to delve in further into this topic or any other topics in BlackRock's 2022 Global Insurance Report. Thank you very much.